Hey, how's it going, traders? Thanks for checking out this video. My name is Travis from Master the Market, and in this video we're going to be talking about how many traders use stop losses the wrong way, which leads to a lot of unnecessary losses in the market. And I'm going to be sharing with you the proper way to use a stop loss so that you can properly manage your risk. So for those of you who may not know, a stop loss is simply an order that is going to automatically exit out of a position for you in order to manage your risk. So for example, if you were to buy a stock expecting it to go up in price, but it kind of failed to meet your expectations, you never really got the chance to lock in profits on that trade, and then the stock actually fell below the price that you bought at, causing a loss on the trade, you could have a stop loss set below the price that you bought at in order to automatically exit out of that position for you, which is of course going to help you keep your losses small and avoid taking large losses on any given trade. Now, when it comes to the type of order that you're going to set, there are really two different main options for a stop loss order. The first is going to be a stop order, which is simply going to sell your position at the market once a certain price is reached. So with the stop order, you can set your price, and once that price is reached by the underlying stock, it's going to turn into a market order to automatically sell your shares and immediately get you out of the position. With a stop limit order, on the other hand, this is actually going to become a limit order to sell once a certain price is reached. So you're not only going to select a stop price, but you also have to set a limit price, which is going to be triggered and activated once that stop price is reached. Now, in my opinion, stop limit orders are a little bit more risky unless you're being very generous with where you're placing your limit price, because with a limit order, there's no guarantee that that price is going to be filled, which is not going to be a problem with a regular stop order since it's going to be sold at the market. Now, very quickly, if we take a look at this recording of my screen from a Robinhood account, I know a lot of the traders that watch my videos use Robinhood, so I wanted to share this to explain how you can actually set a stop order in your Robinhood account. First, you of course just have to go to the stock that you want to trade. Most likely, since you're setting a stop order, you're already going to have a position in this stock. Then go ahead and click on trade, and you're most likely going to be using a sell stop to sell out of your position. So you would then go ahead and select sell, and then in the upper right corner, you're going to see an option for shares. And if you go ahead and click on that, you can see under conditional orders, there's going to be the option for a stop order as well as a stop limit order. You can then go ahead and select which one you'd like and go ahead and place your stop price. Or if you're using a stop limit order, you would select your stop price as well as your limit price to sell. This is pretty much going to be the same process with any different brokerage that you're using. So over here we have an order entry box for E-Trade Pro, which is another very commonly used brokerage. All you have to do in this case is make sure that under price type you have either the stop on quote, which is just a regular stop order, or a stop limit on quote, which is of course going to be a stop limit order. And again, all you would do then is select your stop price as well as your limit price to sell. Now, using stop orders in the Thinkorswim platform with TD Ameritrade is going to be a little bit different because they have the active trader platform, but still it is very simple. So all you would do is make sure you're on the trade tab and make sure you have an active trader box pulled up. Now, if we wanted to buy this stock, Apple, for example, the current price of Apple is $133.55. So if we hover over the buy side of the active trader, at any price below that, you can see that by default it's going to set a limit order to buy if the stock falls to that price. The same is true if you set a sell order above the current price. It's going to be set as a limit order to sell once the stock goes higher and reaches that limit price. Now, if you were to set a sell order that is below the current price of the stock, you can see that by default it changes it from a limit sell to a stop sell. So now you're automatically going to be placing a stop order by selecting to sell below the current price of the stock. Okay, so now that you know exactly what a stop loss order is and how you can actually place them in a few of the most commonly used trading platforms, I first want to talk about what not to do when it comes to using a stop loss. And this is a very common mistake that causes so many new traders to take loss after loss after loss, which they can really easily avoid by just following some of the things that we're going to talk about here in just a minute. So what this mistake is that most traders do is they will place a stop loss just below a key level on a chart. And that's going to be some kind of support level, a trend line, maybe some kind of indicator like the VWAP, and so on and so forth. And that's actually not the mistake itself. You do want to use something on the chart like support, trend lines, or VWAP to kind of base your stop loss off of, but you have to be very cautious with the way that you do this. And unfortunately, many new traders are not, which is going to cause them to get stopped out during a false breakdown below one of these key levels on the chart. And then they're going to miss out on the bullish move that happens afterward. So for example, if we take a look at this chart for Facebook, you can see that at the market open at 9:30 a.m. Eastern Standard Time, Facebook forms a low and actually spikes back up. So that low point at the open is naturally going to become a little bit of a level of support, being that it is the opening range low. Fast forward about an hour in the future, the stock pulls back to that level. It seems to bounce up above that level and hold as a level of support. So right here in this area is where a lot of people would see that support level starting to form and then go ahead and buy into Facebook for a trade. Now, because there is a level of support, there's going to be a lot of stop losses that are placed just below that support level because people are going to want to cut losses on their trade once that support level is broken. So on this false breakdown here, when it briefly breaks below that level of support, there's going to be a lot of stop losses that are hit, causing many traders to take a loss on this trade right before it spikes back up and actually has a big run to the upside. So in this case, not only are you missing out on this big run to the upside that does happen, but you're also taking a very unnecessary loss on the trade by not placing your stop loss in the proper place. So the very simple solution to this problem is to give your stop loss some wiggle room below any level on the chart that you're using to base your stop loss off of. In my opinion, you should allow anywhere from 3 to 5% below a support level before your stop loss is actually triggered. So believe it or not, if there was a level of support on a stock at $10 per share, there's a lot of new traders that don't really understand that you need to give it some wiggle room. So they'll place their stop losses at $9.99, $9.98, and so on and so forth. They're not giving it enough room to actually breathe. And because of that, they're getting stopped out on these false breakdowns below that support level and then missing out on any moves to the upside. So again, you want to give it some kind of room below any level on the chart, which is still going to help you manage your risk if the stock is really going down, but it's going to drastically reduce the amount of times that you're stopped out on a false breakdown. And as far as the amount of wiggle room that you want to give the stock goes, it's really going to be dependent on that individual stock and that individual setup. So for example, if we take these two charts here and compare GameStop stock on the left side to Bank of America stock on the right side, on any given day, a stock like GameStop trades within a pretty big range of at least 10%. Okay, now when you compare that to a stock like Bank of America, which is much less volatile and much more consistent and stable, Bank of America trades within less than 1% of a range on any given day. So in order to properly place your stop loss, you have to know which kind of stock you're actually dealing with. Is it a highly volatile stock that trades within big ranges on any given day? Or is it a slow mover that doesn't trade within big ranges and stays within maybe 1 to 2% within any given trading day? If you're dealing with a highly volatile stock like GameStop, in that case, you're going to want to give it a little bit more wiggle room below any level of support than you would with a less volatile stock like Bank of America. Okay, so now at this point, you may be thinking that you're going to be taking larger losses on a lot of these trades since your stop loss is set so much further below a level of support. So I just wanted to share that ideally that should never be the case. You might be risking a couple of extra percent below a support level than you would have previously by using this type of stop loss strategy. But the way that you can offset that is by adjusting your position size based on your max risk and based on your distance from your stop loss. So even if you're risking a larger percentage, you should still be risking the same amount of money that you previously would. This is going to again keep your losses small in terms of how much money you're actually risking and how much money you're losing on any given loss. But the big thing is that it also should greatly improve your accuracy in the market and of course prevent you from getting stopped out in a lot of these false breakdowns and then missing out on the big move that happens to the upside following that false breakdown. Okay, so that's going to be a wrap on this video. I hope you enjoyed and learned something about stop losses and how to properly manage risk in the market. If you enjoyed and found some value in this video, please make sure to give it a like and subscribe to the channel so you don't miss out on future videos and future trading lessons. And of course, if you want to learn more about day trading, swing trading, and even long-term investing, we start from the basics and gradually get more advanced, sharing trading and investing strategies. And our programs also include exclusive market resources and access to our trading chat room with over 1,000 active traders in it daily. All of that can be found on my website, Master the Market, which is going to be linked down below in the description. But anyway, thanks again for watching. I hope you enjoyed, and good luck with your trading.